In this episode of On the Tape, I welcome back Luke Gromen, founder and president of macro-thematic research firm Forest for the Trees, which he founded in 2014. Luke was last on in March when he reiterated his cautious stance on the markets ahead of the tariff announcements. While that was the correct call, Luke now believes that the back half of 2025 might be positive for risk assets as short-term benefits of the tax bill and deregulation coupled with dollar weakness could provide a boost. But Luke's longer-term concerns remain and sees gold and Bitcoin benefiting from market volatility and uncertainty, each with different catalysts. We discuss the continued decline of the dollar as the world's reserve currency and how the yen and the dollar weakening at the same time could have consequences. We discuss Powell and the Fed as well as Bessent's strategy to keep yields low with the help of stablecoins. We hit tariffs, China, and lots more, so please enjoy this episode of On the Tape. Great to have Luke Gromen back on the pod. Luke is the founder and president of macro-thematic research firm Forest for the Trees. Prior to that, Luke was at Cleveland Research. Prior to that, he was at Midwest Research. That's where I got to know him a little bit back in those two places. And Luke, you were last on the pod on March 18th, and markets were selling off. It wasn't the official tariff day yet, but we were about 8% off the highs. You had told clients coming into the year you would stay, quote, low on your skis. You said on that episode you would also stay low on your skis. So here we are. We dropped another 13% to the lows on April 8th. As we sit here, we're up 6% on the year. So I would say low on your skis, down a double black diamond with moguls on it we've had here. So give us your current thoughts on the market and welcome back to the pod.
No, I appreciate it. Thank you. Yeah, it was interesting. And it was once again, to me, another tell of the famous Denny Green post-game press conference for the Arizona Cardinals, right? They are who we thought they were. April showed us they are who they thought we were, right? They are who we thought they were, which is that our view is that basically there is a put, and the put is on Treasury vol, right? There's a cap on Treasury vol. And so 7 days after Liberation Day, Treasury vol intraday traded at 172 on the MOVE index, which was like basically, as the creator of that index, Harley Bassman, called it, the stop out trade. Like no human can trade that. So shortly thereafter, Trump said the bond market got a little queasy and squirrely, and he and Bessent backed off. We got a little more constructive there. If I was the perfect analyst, I would have said to myself, don't grow a brain. Like we've seen this before. They're going to do whatever they take to get Treasury vol back down. They did. And sort of that's where it gets us to the up, whatever, 6% year to date. As we sit here today, I'm of two minds. And I don't fully know how to weight them. I think over the course of the back half of the year, I'm net bullish. And the reason but there's some very near term concerns I have, and I don't know kind of how to weight those. So I'll start with why I'm bullish for the second half, which is I think going to keep weakening the dollar. I think there'll be a lagged effect of the dollar weakness we've seen already. Generally speaking, you weaken the dollar, you're going to have better growth globally. Better risk markets globally. And so that's a bullish factor. I think a not appreciated factor is something that just happened in the last 2 months post-Liberation Day, which is it was revealed that the United States can't go to war without China. Full stop. End of discussion. And neither can Israel. Israel can't go to war without China. You can Google around if you're interested, you listeners, various stories. The U.S. ran through a reported 15 to 20% of its THAAD air defense missiles in 11 days of medium intensity combat defending Israel. 15 to 20%. Those things take years to replace. And we have heard chapter and verse Trump, Lutnick, Bessent complaining about rare earth magnets not arriving fast enough from China. And so I think paradoxically, what was shown over the last 2 months was the U.S. can't go to war without these Chinese rare earth magnets. We run down our stockpiles too fast. And so can we eventually rebuild them? Sure. Can we do it in under 5 years? Probably not. And so I think we've got safely a piece, a 6 to 12, 18-month stretch where there can't be any major global conflict because everybody needs China to do it. So that's actually, number one, weaker dollar, number two, peace. And then number three is what we're seeing develop with the one big beautiful bill, which is, I think it's a big deficit. We know what to do with big deficits. It tends to be stimulative. And we've got what the Trump administration, to me, seems to be a version of what Yellen did, right? If when we go back to the fourth quarter 23, Yellen shifted issuance forward into the T-bill market, and it was stimulative through 24. And I'm looking at what they're talking about doing with stablecoins and shifting issuance to the front end, and I think basically Yellen used the reverse repo market to do it, and I think the Trump administration, and Bessent specifically, is looking at trying to shift to the front end and use stablecoins to do that. So those are the kind of the bullish dynamics, why I'm on net bullish for the back half of this year. Now, as I sit here today on, July 8th, the thing that's really given me some discomfort in the very short run is obviously not just trade disruption. We saw a brief glimpse of that yesterday when Trump came out and sort of started swinging the tariff stick again, including against our supposed allies against China, South Korea, and Japan. But I think more importantly, something we highlighted about a month ago for clients, which is since the Bank of Japan removed the yield cap on their yield curve control program on 10-year JGBs at the end of July in 2023, stronger yen has driven lower 10-year JGB yields and vice versa. And about 4 months ago, those two diverged. In other words, stronger yen stopped driving lower 10-year JGB yields. That's a problem. That's problem one. At the same time, since that same late July 2023 Bank of Japan move regarding their yield curve program on 10-year JGBs, the 10-year U.S. Treasury yield has been highly correlated with the DXY, the dollar index. Weaker dollar, lower 10-year, and vice versa. In the last 2 months, 3 months, that has diverged as well. And so that's a problem, because ultimately you get 10-year JGB and or higher 10-year yields past a certain threshold, and we can discuss or debate what those levels are, but they're not that far north of here. You're going to have big risk off, big problems. And it's a really big problem because historically we've seen both of these countries more than willing to sacrifice the value of their currency to control their bond markets, right? They print money and buy bonds. The problem is they both can't do it at the same time, because they'll be driving. They're the counter pair in each's relative currency. And the other problem is they're the two biggest funding currencies in the world by far. So when they have a problem, it's going to show up everywhere. And so I think we're seeing rumblings of that again today. We saw it yesterday in the Japanese bond market. We're seeing in the 10-year. The 10-year in the U.S., I think, is up, 10 or 15 basis points in 2 days again. It's like, here we go again. So it's, this bullish full term against this short term. Like, I've seen this before, and this tends to be another period where you want to be low over your skis. So I'll stop there. We can sort of pull on threads however you want to pull on them, and go from there.
Yeah, it's really short-term gain, long-term pain potentially. I want to break down each of those issues that you hit. I want to start with the dollar and the debasement of the dollar. You put out a tweet, or an X, whatever you want to call it, the other day, that U.S. share of global FX reserves, including gold, are now less than 50%, and that gold is now the second biggest FX reserve asset behind the U.S. dollar. At what point, when the dollar keeps dropping like this, yes, it's great for risk-on assets. At what point does it become counterproductive and really start to unravel markets?
It's a great and $64,000 question, right? Because at some point you got two opposing factors there, right? You've got the capital flow aspect, and you've got the debt aspect, right? So all else equal, so foreigners are, I don't know, they've borrowed some $13-14 trillion in dollar denominated debt around the world. And so as the dollar weakens, right, that's effectively a debt jubilee of sorts. It's stimulative. That will drive global growth. That's a good thing, at least in the immediate term and intermediate term. The flip side to that is, at some point, too much dollar weakness starts to drive inflation, and inflation is bad for bonds, and that creates a risk off. So there's very much on sort of a, I don't know where Cliff's edge is on that. The second issue is sort of the capital flow dynamic, which is foreigners on the other side of their balance sheet to their $13 trillion debt liability in dollars. They have on a net basis, call it $22 trillion of dollar denominated assets. And so at some point, the dollar gets weak enough, or if it gets weak in a disorderly fashion on the downside, you could see selling of dollar assets to get out of dollars, in which case, you get what we saw in April for a bit, right? Which was dollar down, bonds down, stocks down. And that's something American investors generally are like, whoa, what's this? And if you talk to someone in Brazil or Argentina or Turkey, like they're, oh, this is capital outflows. We know this movie. We know how this goes. So those are the factors driving it. To answer your question, or the factors to consider, to answer your question, I don't know. Like, when does it get weak enough? When does that share? There's a lot of different puts and takes. I would argue, and have argued, that shifting to a neutral reserve asset system, gold, right, making gold the biggest FX reserve asset, which I think is, that chart shows we are in that direction. If we just continue on this course, certainly with central banks buying over 1,000 tons a year, as they've done the last 3-4 years. I think that's ultimately good for the U.S. It forces a much weaker dollar. It forces us to rebalance the economy in the way that Trump and Bessent and Vance and others have talked about. But the devil's in the details, right? The execution risk, the markets, how do you manage that process? It's a tough one.
So to your point on Japan, in the letter that Trump sent over yesterday about the tariffs, nowhere in that letter did it say, and I know you're the largest foreign holder of U.S. Treasuries and we appreciate your trust in us. Nowhere did it say that. And to your point, if the yen weakens and the dollar weakens, right, and that's why I think we're seeing what's happening right now in Japan in their debt markets also, at some point they have to come in and defend, right? And do they do that by selling U.S. Treasuries? So the point you made, dollar going lower, if that's coupled with Treasury yields moving higher, I'd imagine then that's what we saw a little glimpse of in early April. That's the nightmare, which is why Bessent is so focused right now, obviously on the 10-year yield, but also on the Fed, and why everyone else is doing everyone else's dirty work, pounding Powell and making, because to your point, they got to issue T-bills, and the Fed only controls the short end. So with that in mind, obviously yields moving higher is a nightmare, but where does the 10-year yield start to really matter? It feels like 4.5% seems to be the symbolic level as we kind of approach that.
Yeah, I think that's right. I would say it's probably, I don't know, 4 or 5 people start to get the yellow flag. I think beyond 4.6% to 4.8 is where people really get worked up, and you start to have, it starts to become a reflexive impact at that point, because selling begets selling, especially when your biggest marginal buyers are, one of the biggest marginal buyers in recent years have been these relative value hedge funds who operate on high degrees of leverage and very short-term time horizons for returns and very strict volatility mandates, right? I mean, it's not necessarily, they may like short-term treasuries there, but if they are levered, gosh, FT reported 2 years ago is anywhere from 50 to 500x on some of these positions. So, as you know, bond vol hits a certain level, or forget bond vol. Vol anywhere hits a certain level, equity vol, because 10-year yields have hit 4.6%. Equity vol starts to rise as stock markets fall, and their models are clear. It's like they get a tap on the shoulder from the risk manager, degross now. Okay, well, what's the easiest thing to degross? Treasuries. Start degrossing now. And we've seen this play out repeatedly in various instances since 2019. We saw it again in April, and that's, that it's a tricky setup, because it ultimately means the U.S. has no leverage against China, because China can go months, quarters, even years, judging by their COVID experience, of taking pain. We did Liberation Day, and 7 days later, the Treasury market was essentially blowing up, and because of what we just laid out. So, I would say 4.5, 4.6, which, we're another bad day or two from those levels as we sit here today.
So let's talk about the tax bill that was just passed. You kind of glossed over that a little bit, and I don't think people have taken the time, maybe some people have, to kind of look through it. Forget about social consequences. I'm talking about fiscal consequences. Everything's very front-end loaded to benefit, the taxpayer, companies with write-offs, and then what they did was they made it post-midterm elections where all the pain could potentially be felt. So here we are. We lifted the debt ceiling from $36.1 trillion to $41.1 trillion, right? So we're going to have a free run, obviously. We'll probably be at that level in a couple years. At what point, does that really matter? Is anyone going to care? To your point, throw caution to the wind and just buy the S&P, because until then we won't worry about it. We kick the can. Talk about that, how that was orchestrated, and what your thoughts are, in general on the deficit.
Yeah, I mean, I've not gotten into all the nitty gritty on it because so much of it changed, and quite frankly, it's out of my bailiwick in terms of the whole breakdown. So I've looked at it more from a top-down 30,000-foot view. So one of the best I saw was from budget analyst Mark Goldwine, and it showed a chart. And it's up and to the right at about a 37-degree angle for the next 10 years in terms of the spending, right? And it's like, okay, well, and it was like best case, it's like a 38-degree angle, and worst case, it's like a 35-degree angle, but like the course is set, right? It's not at a negative 25. It's not at a 0 angle. It's not at a 10 angle. So, we're going to run big deficits. And I think it's critical too, in all of these CBO measurements, it's very rarely mentioned that all these 10-year outlooks are based on no recessions ever. And they tend to come around more than once every 10 years, as it turns out. And when we have them, the deficit rises by, 6% of GDP on the conservative side, as we saw 01 to 03 or 01 to 02, and 8% in 08 and 12% during COVID, which was kind of a special case with the shutdowns and what have you and the stimmies. So, like, to me, my takeaway is, okay, if it's up and to the right at a somewhere between 35 and 38-degree angle, and it doesn't factor in recessions, in which case, the deficit is going to blow out by probably 8% easily. It's stimulative. At the end of the day, it's stimulative, particularly if married with what they seem to be trying to do with moving to the front end and stable coins, right? Like Bessent is, the earnings estimate on Bessent's stable coin T-bill usage has almost doubled in a month, right? About a month ago, he said, well, estimates are for 2 trillion in stable coins, or 2 trillion in T-bill buying by stable coins. And like 2 weeks ago, it's like, well, after the Genius Act, it might be 3.7 trillion by the end of the decade. So, setting aside any moral political side of it, we're going to run big deficits. We're assuming no recessions, and we're going to finance more of it in the short end. Like, I know what to do with that. It ain't bearish. It's bullish and it's inflationary. When does it become a constraint? It becomes a constraint, I think, as we saw in 22, when inflation gets to 8% and it becomes a political issue. Then it's an issue. And I think that's probably instructive for sort of what we've just seen here with raising the debt ceiling, what have you, which is, it's July 8th. Midterms are in 16 months. By the time they get to this stuff dispersed and what have you, it's probably not into the third quarter, maybe early fourth quarter. To me, the gamble might seem to be, hey, we're going to run Bidenomics. We're going to increase spending, and we're going to issue more at the front end to pay for it. And hopefully we can get the Fed to cut. But if not, the stable coin stuff, maybe we can work around that. At any rate, and cross our fingers that inflation isn't 8% by October of 2026. Maybe it's only 4 or 5 up from wherever it is today. And I think that's the gamble.
Well, if that's the gamble, Luke, then I guess you can kind of pretend, not pretend, but the back half could be okay. But let's go back to the Fed for a second, because the Fed's gone. I mean, he's gone one way or another, Powell, in 9 months, 10 months, right? So he has 7 more meetings or something like that left. And if there's a shadow Fed president announced or whatever might happen, we'll just start to look forward. And so if the market starts to project upon that, it'll say that inflation readings are going to move higher. And if that would be the case at some point, then it becomes self-defeating, correct? Because if the thought would be you're going to cut short-term rates into what could be increasing inflationary pressures, that's the nightmare scenario. And I see that, if that were to be the case, happening sooner rather than later, meaning that's a back half of 2025 event. So what are your thoughts on the Fed here and Powell? And this tariff noise just makes it harder on him he has an excuse now again to not cut in July. And if you're watching Fed fund futures, right, they're trading with the tariff announcements basically. Now we're back to very low probability in July. A week or so ago, we were 30% or 40% chance. It shifted. Yes, we're probably going to get a cut in September. But talk about the Fed a little bit and how Powell's gonna stay credible and or powerful, I guess.
Yeah, here too, I like it. It's challenging, right? People say, well, we wanted austerity, wanted Doge. We don't want this inflation. It's like that they can't cut. We've seen Plan A won't work. Of take pain, push people into the bond market, Doge, term out the debt. That failed. Full stop. As we thought it would, by the way. Powell's in a tough spot. Like, our case all along. I think it just depends on kind of who is Powell's master, right? In other words, if Powell wants to do what's best for the dollar, then he won't cut with inflation, all this stuff. And that's what's worst for the US. Like if he does that, he's ensuring that the US is going to lose to China. Full stop. Or, we've heard repeatedly, we're in a new Cold War. We're in a, COVID is like World War II. Well, what did the Fed do in those cases? The Fed subjugated itself. They bought, they kept yields, they ran inflation hot, they kept growth far above rates, and did what they had to do and sacrifice the dollar and inflation in order to achieve some broader national goal. And so that's where I'm a little bit of, I can't figure out what, whose side Powell's on. Is he on the side of the dollar or is he on the side of America? Because they are now at diametric opposite sides. And, there's a case, we wrote at the time, people said, well, Powell's going to be the next Volcker in 2022. I said, if Powell wanted to be brave, if he wanted to do the right thing like Volcker did, he would have let inflation run higher for longer. He would have taken, the hate from the politicians and let inflation run hot, get the GDP down and position this country for growth and investment in a way that he didn't do. So I can't figure out whose side he's on. You want to put on a tinfoil hat. One way, it's said he meets with Bessent, weekly or quarter or monthly, at least once a month, right? So we know they're talking about these things. We know it. If you want to put on a bit of a tinfoil hat and say, okay, we're going to do all these things that we're going to do, which is, increase deficits, run issuance to the front end, and to your point, like this should start to increase term premiums, inflation expectations. That's a problem at some point, maybe as soon as later this year. If I want to put on my tinfoil hat and I sit there and someone says, Luke, come up with a way to trick the bond market, to delay the time until term premiums really start ripping. How do you boil the bond market frog? I say, make Powell the bad guy, right? Use Trump's wrestling kayfabe. Bessent and Powell get together every week, every month, whatever it is. And Powell says, listen, I'm going to sit there and I'm going to be a prick and I'm not going to cut and I'm going to, and you just keep harping on me, make me the bad guy, because by you making me the bad guy, you're making me look like I'm, because I do think if he comes out and goes, screw it, we're cutting rates to zero to finance, like he loses the long end. Like the long end goes, oh my God. So he's got to be very delicate. So to me, the most gracious or the most generous interpretation of what we're watching is some version of kayfabe, wrestling kayfabe, to basically keep anesthetizing the long end of the Treasury curve while we're doing all this spending and talking about moving to the front end or whatever. So it's a very delicate, dangerous game. I do ultimately think he will cut, but I don't have a strong feeling on that at this moment. The reality is their operating room is tiny because he didn't do the brave thing in 2022 and 2023, which is let inflation run hot, let the Democrats get thrown out in 2022 for their programs, by the way, which again, they had to run just to keep the wheels on the cart because of the programs before and the programs before and the war before and the bailouts before. So like everybody's got a hand in getting them to that point. Like he didn't do the right thing in 2022, 23. Now the operating is really tiny. it's kind of a rambling, like my rambling on this is a reflection of lack of conviction around what the operating room relative, which is tiny. Like they're cornered. Go back to what I first said about the 10-year and the 10-year JGB, like, and relative to their respective currencies. They're in trouble. They're cornered.
Never has there been an instance where you could say the stock market is not the economy and the economy is not the stock market. It's never been more true than right now. And I think that the wealth effect in the stock market, the few stocks control the S&P, and a small percentage of the population controls the economy, right? It just is. And so it feels like we're getting false positives, if you want to call them that the market is affirming that all our policies are going to, quote, work out because the stock market is performing. If that reverses itself, and we've seen it a few times where you start to, oh, well, that's why the market's down. Oh, there's no faith in our bond market. Oh, there's no faith in the dollar, things like that. So it doesn't take a lot to kind of strip out that type of confidence, and we saw it in April. So if we have that moment again, it feels like that when you peel it back, the things we're staring at now, that all the things we just talked about, like the long-term issue with our debt, deficit, economy, things are slowing. What does that look like? Because it feels like it could feed on itself to the downside if that were to occur.
I think it could, and then it gets really tricky, right? Like the trifecta of dollar down, stocks down, bonds down is the Fed's worst nightmare. Because what do? Do they, especially with debt to GDP at 120%, if they let bonds keep falling, interest is already 25% of GDP, or excuse me, 25% of receipts, all-time high receipts, by the way, receipts that are heavily and immediately influenced by the stock market. So as the stock market's going down, rates going up, it's going to go 25, 30, 35%. And by the way, entitlements are 70% of receipts. Those are just interest on the off-balance sheet liability. So we're already, as we sit here today, with receipts at all-time highs, and receipts, all-time high receipts that are quickly and significantly on the margin affected by stocks. Stocks go down, they're going to go down with a slight lag. We're already at 105% of receipts, all-time high receipts on our interest and interest-like obligations, which is gross interest, entitlements, and Veterans Affairs. So, they to me, if you have that moment, it is what the fact that we're already at over 100% of all-time high receipts says it can only be a moment, unless Powell and Bessent say, you know what, we're just going to let some treasury auctions fail, right? We're going to let treasury vol go to 172 and everyone's going to stand aside and we're going to let markets trade where they trade. They're not going to do that in the treasury market, in my opinion. I think there's a zero chance of that ever happening. And so as long as that's the case, look, we go back to 2019, repo went to 8 to 10% for 48 hours, and then the Fed acted. 1Q20, 10-year yields started rising rapidly in the depths of COVID. Fed got on it right away, $600 billion a week in QE. Have a good day. We saw it in, 3Q22. It was more Yellen at that point than the Fed, basically running down TGA to weaken the dollar, to offset Fed QT, to stop Treasury dysfunction. We saw it in 1Q23 with BTFP, right? We saw those banking issues, and all of a sudden 10-year yields started going up. Why? The same reasons it's been happening. BTFP, which was just yield curve control for American banks from the Fed via a swap program. 3Q23, we saw a shift to the front end by Yellen. So again, it was Treasury. We keep seeing this. So, and then earlier this year, right, we do Liberation Day and the Treasury market throws up on itself within 7 trading days. And Trump, it was the genesis of the taco trade, right? Trump always chickens out. Bond market beat him over the head, him and Bessent both. And so this moment that, maybe we would get, I think it's very possible we're going to get another one of these moments just by virtue of the math. It can't last more than days, maybe a couple weeks. And so it makes it tricky as a risk manager, right? Because you run an institutional portfolio. You can't reorient, $1 billion portfolio in for a 2-week drawdown very easily in, out, it's tricky. So that's what I think it would look like is, sort of another whoosh followed by an immediate Fed or Treasury policymaker, they'll call it whatever they call it, BTFP or rundown. It's dollar liquidity. They're going to sell dollars to buy bonds at the end of the day.
BTFD, it actually would be, right? At that point on the dip side. All right, so let's go in a few things here. Oil, gold, ratio, which you talk about. We didn't get into gold enough here. We mentioned it kind of from a reserve perspective, but talk about gold feels like it's in like an intermezzo stage here right now, taking a deep breath, and it feels like it's about to move higher again. Thoughts there, and why the oil gold ratio matters to you?
Yeah, so I do think it's in sort of this pause, and it's probably a shifting of hands from sort of the tourists who all owned it as a war hedge and a trade hedge, and um, to those people. I understand why you sell it on sort of peace, and I think it's the wrong thing to do because the peace is being forced by somebody who wants to shift to a more gold-based system, which is to say China. And we can see that in their actions. So I think ultimately continues to grind way higher. I think its share of global FX reserves will ultimately overtake the dollar, probably a couple, 3-4 years from now. But in the next 6 to 12 months, I think gold continues to go higher. Why is the gold to oil ratio important? It's important because it is a temperature gauge on the petrodollar system. It's a pressure gauge on the petrodollar system and on the de-dollarization of global FX reserves. How? Well, historically, a low gold to oil ratio is a healthy petrodollar system. Gold competes with long-term treasury bonds as a reserve asset. So low gold price means low competition with treasuries. And a relatively high oil price means that there's a lot of demand for dollars to buy oil. And it means that there's a lot of OPEC dollar surpluses being recycled into treasuries, right? So low gold to oil ratio, low gold, high oil. And that's a very healthy petrodollar system as it were structured. As the gold to oil ratio rises, it's a pressure gauge on the petrodollar system. So gold rising means there's starting to be questions about long-term treasury bonds for any number of reasons, which we've been seeing. And lower oil prices, once you get too low, you start to see selling from those OPEC, selling of treasuries, selling of dollar bonds, as Saudi is doing in size already this year, because they are, the oil prices aren't high enough to pay for all of their fiscal spending. So higher gold, as the gold to oil ratio goes higher, or one read of that is a pressure gauge of the health of the petrodollar system. Now, it's also a sign of multi-currency oil pricing, right? Because something people have been harping on is, well, we've seen China is buying more oil on the margin in yuan. They've been working on it for 10 years, particularly with Russia, Iran, which is probably no small part why they are part of the axis of evil. And the flows of that are pretty straightforward, which is China runs a deficit against said oil producer. The oil producer ends up with offshore yuan. Most of the yuan gets recycled into Chinese goods. And so we can see that in the trade metrics. You look at the chart of Saudi and Chinese trade, like, Chinese exports to Saudi, it is like up and to the right at a 45-degree angle for the last 10 years, 10, 12 years. And then anything net that is not recycled into Chinese goods goes into gold. And you would see this in two ratios. You would see this into gold to oil ratio, number one, because you're going to basically be having net oil surpluses bidding for gold. And the oil market alone is some 10 to 12 times the size of the physical gold market in terms of annual production terms. Check. And you would also see it in the Chinese yuan falling sharply against gold, which particularly since the U.S. invaded the USSR, not even the USSR, Soviet Union. Let me try one more time. Since Russia invaded Ukraine in 2022, the price of Chinese yuan, gold in Chinese yuan, is skyrocketed. So everyone keeps looking for the yuan to devalue against the dollar. They're missing the show. Chinese yuan is devaluing massively against gold over the last 2 years, 4 years, 6 years. By design. That is, people keep saying, what's the BRICS currency? There's no BRICS currency. BRICS currency is gold. It's gold. They're trading more in local currencies, and they're net settling in gold. It's goods in gold. So that's why I think the gold to oil ratio is so important. And I think ultimately it ties in with the yuan price of gold. And you look at that yuan price of gold, it's very elegant. Number one, the Chinese, over the last 25 years, the government told their people to load up on gold. So as the yuan price of gold goes up, guess what happens to Chinese consumer balance sheets? They improve, they strengthen, their assets rise. The other thing is it's a virtuous cycle of trade. As the price of yuan gold goes up, if you're holding gold as Saudi or as the Russians, your purchasing power in Chinese yuan goes up. It's our currency and our problem for your Chinese trading partners willing to participate. And the last thing is that because China's now gotten this big enough, they're controlling the gold price, right? It puts pressure on the U.S. If the price of gold goes up in yuan, it doesn't follow in gold in dollar terms, then the dollar is going to strengthen against the yuan, and the Chinese are going to outcompete us in industry. And if we do it, it ultimately weakens the dollar, which prior administrations didn't want. Some on Wall Street don't want, but this administration wants. And so I think it's actually really, it's a leading, the gold to oil ratio, the price of Chinese yuan gold going up, both leading indicators of, I think, dollar gold going up over time.
So what is fair value, you think, for gold right now, if you were to actually equate it to what you think that ratio should be? Is it 10,000, 15,000 right now on gold, something in that realm?
I've looked at a couple different ways. Dan Oliver at Mermiccan Capital noted that, as it relates to the Fed's balance sheet, the gold is at market value is only like 13% of the Fed's balance sheet, which is the same price it was in 1968. Same percentage it was in 1968 before gold went from $20 to $800 over the next 12 years. So up 40x, right? That's an extreme case. The one I've always gone back to is this market value of U.S. official gold as a percentage of foreign held treasury bonds outstanding. And that ratio long term ran at 40%. It was never below 20% until 1989 when the Berlin Wall came down, USSR fell. Today, as big a move as we've had in gold, it's at 10%, right? So I think gold would have to at least double just to kind of get back to the low end of that range, and probably, to your point, quadruple to kind of go back to the long-term average, and $10,000 to $15,000. And I think ultimately, it's worth noting for context that if there's actually an honest to goodness dollar crisis like there was in 1980, that ratio went to 135%. So basically, the U.S. foreign debt was 135% gold backed de facto, and that's extreme. I don't think that's going to happen, but that's, I think, an interesting data point.
So let's shift to digital gold then here at Bitcoin. Give us your current thoughts. You've been positive on Bitcoin, and I think more so in the last kind of few years, I would say, right, as it becomes a much more important part of people's portfolio, and I think the advent of ETFs, et cetera. So thoughts on that and where that might be headed?
Yeah, I was at the Bitcoin conference last July, right around this time, and I participated in a podcast. You can find it online publicly. And in it, the host noted they were at a party the night before with a very famous person who had talked to Trump, and Trump told them Bitcoin is the new oil. And at first, I just thought that meant. It's got the energy proof of work, right? There's always an energy tie that I've always highlighted, and a lot of Bitcoin people have as well. But as time has gone on, and last fall, we saw Paul Ryan write an op-ed in the Wall Street Journal about how stable coins can help finance the deficit. And then we saw the Treasury in the quarterly TBAC do a supplemental report in October about how digital assets can help drive T-bill demand. And then we saw it again in the March report. And now we've seen what we've seen with Besant and stablecoins and the Genius Act and Trump. And my thinking on this has evolved to Bitcoin is one of the beauties about Trump is he will tell you exactly what's happening, but he'll sort of screw up the language a little bit. Like he'll get the main thrust of it right, but he'll screw up the details. And when he's telling this person Bitcoin's the new oil, I think what he was saying was in the same way that in 1973, the U.S. facilitated the petrodollar deal. We basically engineered a massive increase in the 400% increase in the price of gold, in the price of oil, to make the oil markets, and then tied the dollar to it, right, through Saudi, to make the oil market big enough to sort of back our deficits. I think that's what this administration is looking at stable coins and Bitcoin as, which is, and that's becoming clear in the last month or two with the Genius Act and what Besson has said. He thinks we can do 3.7 trillion in T-bill, and stable coins can grow to 3.7 trillion, sucking up liquidity from other places, right? As people have the digital dollar backed by T-bills on their phone. That's just a digital version of the original petrodollar. That's Bitcoin is the new oil. And to me, historically, you look at stable coins as a percentage of Bitcoin's market cap. So right now, it's call it 250 billion stable coin, $2.1 trillion Bitcoin. It's just, whatever, 8x, an 8x ratio, market cap of Bitcoin relative to stable coin underpinning. That ratio sort of post 2021 and kind of the modern moving toward ETF era, if you will, has ranged from, call it 2.5x to like 10 to 12x. In other words, Bitcoin market cap bigger than stable coins. And so I look at this and go, all right, well, if Besant says he thinks stable coins are going to 3.7 trillion possibly over the next, by the end of the decade, that's less than 5 years from today. And I apply a 2.5x market cap multiplier to Bitcoin, because I just, it doesn't make sense to me that stable coins are bigger than Bitcoin when the Genius Act provides that these stablecoin issuers can't pay a coupon. Like, people aren't going to hold it, so 2.5 times market cap today's 5 trillion market cap for Bitcoin, right? So, that's, $500,000 Bitcoin from here. 12 times, let's just use 10 for easy math. 10 times the sorry. I did the math wrong. He says 3.7 trillion stablecoin, 3.7 trillion times 2.5x Bitcoin multiplier. That's like a $7.5 trillion market cap for Bitcoin. So yeah, you're talking about $600,000 Bitcoin, by the end of the decade. And then you look at it 10x for easy math. That's 37 trillion Bitcoin market cap. That's a big number.
Really interesting times that we're in here. By the way, you wrote you were pretty sure how the movie was going to end in terms of the market over time. You just don't know the timing of it. I want to quote Steve Perry in Journey. Well, the movie never ends. It just goes on and on and on, which is great for you and me because we can talk about things, and people that don't follow Luke need to follow him on X. And also, Luke, where can they find Forest for the Trees and become a subscriber?
Sure. You can check us out, fftt-llc.com, for more information about both institutional and mass market research offerings. And as you know, I'm on X at Luke Gromen.
Well, Luke, I appreciate you coming back on the pod. Hope to have you on again in a few months. Never a dull moment in this market. And thanks for your time today, Luke. Really appreciate it.
Likewise, yeah, I appreciate it. It's certainly fun times. When it started, I used to have hair, so
mine just grows more when I get, when stress comes in. So we're on opposite ends of the spectrum, but it's the same thing. So thank you, Luke.
Thank you.